Hi, everyone. I wanted to thank you all for joining, and I wanted to introduce Arben, who is the Deputy Chief Economist for RealPage. And very excited about this presentation and to hear some of Arben's thoughts. And Arben, feel free to make an introduction for yourself.
Absolutely. Well, good afternoon, everyone. Extremely excited to be here today. As Chris said, I'm Arben Skivjani, Deputy Chief Economist at RealPage. Have been with the company for a little over 7 years and enjoy every second I spend at the company. I love the industry. I love the people I work with. I also serve as the head of forecasting. In other words, that means whenever our forecast miss, they come and yell at me and blame me for, why did that happen? So jokes aside, uh, for the next, I would say 30 to 45 minutes, Chris, I'll try to share some stats on what's going on in our industry, but only if I could share the slides, because Chris on my end is still saying here, sharing is not turned on. So
Okay.
probably some
Okay.
magic you guys would have to do.
We're turning it on right now.
All righty.
All right. And you should be good on your end, Arben.
All righty. If you give me a second, I will try to. All right. Give me a second. All right. Can everyone see my screen here? Second.
Let's see. Yes, I can see it on my end, Arben.
So it's a full screen, correct?
That is correct.
All righty. Perfect. So would you like me to get started or?
Yeah, yeah, take it away, Arben.
All righty. So in the next, I would say 30 to 45 minutes, just wanted to walk you through what is going on in our industry. A lot has happened, but I think it would be even more important to start with what are some of the external factors, right, that are affecting our industry. Because as I said, a lot happened last year and is still happening that is affecting our industry. You have employment, you have interest rates, consumer sentiment, so on and so forth, that are directly impacting our industry. Then we'll move on to our industry stats. So how the industry is doing. We'll share some data on occupancy, supply, demand, rent growth, all that good stuff. Just in general. And then also, just briefly, we'll go through some of the regions that we follow and how they're doing. But as I said, just in the interest of time, we'll just be brief on that. And then at the end, we'll share our forecast for end of 2026 and 2027. And hopefully at the end of the show, we'll have some time to take at least a couple of questions. So first things first, macroeconomy, right? A lot happened. Some of it was that contributed to rent growth, and some of that actually made our rent growth go down. For example, you had a labor market that is still soft, consumer sentiment that is nowhere near its long-term average. And then, of course, no need to tell me that inflation is still high. And all of that contributed to put a hold on household formation. And household formation, no need for me to tell you, it's pretty much everything in our industry. But then on the other hand, we had some, good news. Wages continue to grow. Our rent to income ratio is at 6-year low, and also capital markets are improving. So they're not healed, but getting there. At the beginning of each year, sometime in January, we publish, our thoughts on the economy. What do we think will happen to the economy? And this is not something that economists like to publish, but nevertheless, I'm going to go ahead and show it to you and see, whether we missed it or we were right on the spot. So at the beginning of the year, we said the labor market will be pretty soft. And guess what? That's what happened. The economy is still creating some jobs. And of course, those jobs support our industry, whether directly or indirectly, but it's not as good as, we would have liked it to be. We said that the consumer sentiment, the health of American consumer, would be pretty weak. And there is, as my next slides will show, there are, plenty of reasons why the American consumer is not feeling well about what's going on in the economy. Uh, and then there were other things like, we have limited international migration, especially in the last couple of years. We still have high interest rates, which we hoped, would go down, but for many reasons they're where they are now. And so two pieces of good news is that supply is coming down, right? And also demand has been pretty good. So what's the verdict for this year? Well, I would say that, it's not, the economy did not behave in a way that we feared. We thought that, we would really have super high inflation, and also maybe employment will, because of AI and many other factors, maybe the economy will not be able to generate as many jobs. But on the other hand, there were some of us that thought maybe employment will do much better. So the economy did not behave as strong as we had hoped. So I would like to pick on that second part of that verdict, not as bad as feared, or rather not as strong as hope, because employment probably is the most important component of our industry after population, and that has been historically. And as I said, many economists thought that probably employment will start to pick up, but actually it did not. So it's kind of playing a positive role in our industry, but also a negative role, as you will see in just a little bit. So what you see here is the historical data on employment, year over year employment change, going all the way back to the beginning of 2023. So if we look at the historical data 2015, 2019, so this is pre-pandemic, on average, employment grew about 1.9%, 1.8%. It's a little below 2%. At the beginning of 2023, employment grew at 3%. And as time progressed, look what has happened, right? Employment growth has stalled. You can blame it on anything or everything, right? You can say maybe it's AI, maybe it's because our economy is not doing well. Probably it's all of them, but we are what we are. Employment has really slowed down. If we dig a little deeper and we look at actual numbers, in July, our economy actually shed about 23,000 jobs. So not a lot, but still it's shed instead of creating. And if we look at that 2015, 2019 average, our economy creates about 190,000 jobs, so pre-pandemic. Now it's at about 66,000 jobs, nowhere near where it should be. So from January to July, our economy of this year, our economy created about 446,000 jobs, a little less than 450,000 jobs compared to last 2 years ago, compared to the pre-pandemic area of about probably 2 million. So still less than where it should be. But if we compare it to 2025, well, it's doing much better actually. In 2025, from January through July, our economy created only about 226,000 jobs versus 446,000 jobs this year. So yes, employment has slowed down a lot. If we want demand to go up, or if we want our industry to go up, employment should be more robust. But yet, still, it's chugging along. So I would say, employment could be better, but not as bad as we had feared. Also, now when we talk about employment, we talk a lot about unemployment rate. In my opinion, nowadays unemployment rate doesn't have that much meaning, because if the number of people are looking for a job goes down, unemployment rate goes down as well. So that's why I think it's labor force participation rate is a much better predictor of the health of the employment sector than unemployment rate, because this takes into consideration both those that are working and those that are not working but are looking for a job. And currently, that labor force participation rate is sitting at 61.5%. 61.5. That is the lowest in 50 years, I would say, right? Going all the way back to 1976. And of course, we would have to exclude the pandemic era. But currently, it's very low, and it's both thanks to, I would say, a lot of baby boomers retiring and also a lot of young adults not being able to find jobs. So again, probably AI is one of the factors to blame for that, but we still don't have enough proof to say for certainty this is what is happening. But one thing we know for sure is that the labor force participation rate is going down rapidly, and it hasn't been there for over half a century. Now, if employment is sort of the engine of not only our industry, but the entire economy, then I would say consumer sentiment is that willingness of consumers, clients to push the pedal, right? So it's very important to have a happy US consumer, happy client, because when US consumers are happy, they go spend, right? When they feel good about the economy, they go spend, and hopefully they go out and rent too, right? Because no job, no money, no money, no fun. So if the more you work, the more you earn, and the more you can make decisions such as, I don't want to live anymore with my roommate or with my brother, my sister, my parents. I want to go ahead and rent. And that leads to household formation. But look at the consumer sentiment where it stands right now. Is it about 55? But back in May, it stood at about 44 and a half, around 45. That was the lowest ever. Not since 2008, not since 2015, but lowest ever. And who could blame the American consumer for not feeling well about the economy? A lot going on, right? You have oil prices going up, you have the Iran conflict, and many other things happening abroad at home. So sentiment goes down as a lot of things become more uncertain for the American consumer in general. On the other hand, we have a stubborn inflation, right? Our mutual enemy for over, well, 3, 4 years now, if not more. So inflation has been elevated, not where Fed wants it to be at 2%. But again, if you look at, where it was back in 2021, 2022, almost 10%, and where it is now, it has come down. And it was coming down pretty rapidly. But then oil prices went up, and now in July, CPI stood at, I would say, 3.4%, and core CPI, which excludes energy and food prices, was at about 2.5%. So it is elevated, and in my opinion, it's going to take a long time before it goes down to 2%, and if ever. But we've had an elevated inflation for over 4 or 5 years now, and we kind of survive it. I'm not suggesting here that inflation shouldn't come down, but even if it is at 2.2, 2.3%, it wouldn't be a big deal. But it's a big deal if it is 3, 4%. Absolutely. Now, if you had shown me this chart back in January, I sort of would have laughed at you. But you see in here is the probability of interest rate hike. So back in January, actually, we're talking about getting a rate cut from the Federal Reserve, right? Because we thought the economy was doing well, inflation was coming down, so we were due for another interest rate cut. But now we're actually talking about a possible interest rate hike. And as of August, that probability stands at about 35 to 40%, right? So right there, sort of in the middle. And chances of getting a rate cut this year is absolutely 0%. So probably will depending on the August employment report, if it's low, in my opinion, this is strictly my opinion, we won't see any rate hike or rate cut this year. It will be there where it is. But if employment improves and is pretty robust, while inflation doesn't come down, then we'll probably see a rate hike later this year. So enough with bad news. Let's share some good news about our industry, at least. Now, uh, if we look at income, it has been sort of a positive or light in our industry. So if you look at 2019, median rate renters earned about rather market rate renters earned about $72,000 versus everybody else about 69,000. Now, in 2025, market rate renters earn almost $100,000, and that's an increase of about 38%, a little less than 40%, versus the rest of us we're making about $84,000 or saw an increase of a little over 24%. So that's a gap of 16%. Now, I'm not going to say that, economy has been great for everyone and there's no hardship. I'm not going to mask that. We know where the economy is. But what I'm trying to say here, market rate renters have seen better days than the rest of the population in terms of income, right? Also, if we look at the rent to income ratio, that has fallen to a 6-year low. So it's currently sitting about 22%, right where we saw it before pandemic. And of course, it's off of those highs that we saw during the pandemic. But currently, our renters are doing better because rents, first of all, have come down. Their incomes have stayed somewhat elevated. So that has made housing a little bit more affordable than it was. Now, another thing that has contributed to our industry, multifamily industry, is our accidental friend, I will say, the cost of home ownership. It has gone up by a lot. I'm not talking just the value of homes, but also what comes with it. I mean, as you just see this chart, a wonderful chart generated by Wall Street Journal, everything else has gone up besides home prices. You have property taxes gone up, insurance has gone up, if repairs, of course, up. So while in 2019 these were home ownership costs on average was about $20,000, now it's $29,000, right? So that's one of the reasons why not a lot of people or why a lot of people are deciding not to buy, but rather rent, because it makes more sense, both as it's cheaper and probably a lot less trouble. Now, since most of you in here are in the capital markets, just a few words here. So we are seeing also some improvement in the CRE, right? Commercial real estate, at least the liquidity is improving. And actually, the CRE is in better shape than it has been in the last 12 months, I would say. So we are seeing actually, sellers who actually want to sell rather than they're forced to sell, right? So the sales volume is up almost 10%, and actually pricing is finally finding the floor. It's up just 1, and then if you look at the lender originations is up by more than 50%, which I think is it's a pretty good sign about the health of this industry. And on the other side, of course, there are risks, right? If you look at delinquency rates, about 4%, nothing tragic, but it's still risk is there. The thing that sort of concerns me is the construction cost inflation, right? I said that overall inflation is up about 3.4%, but look at this, the construction cost inflation here. It's over 8%, so running a little hotter than or rather double the overall inflation. And because of inflation, we look at real wages actually are going down because inflation accelerated instead of decelerating. But overall, CRM markets are healthier today than they were just a year ago. Now, this is the chart that I used to stress test the optimism of the American consumer. Because if the health of the American consumer is not that good, it would show up right here, right? So what we're looking at is that the delinquency rates on debt more than 90 days for delinquent. And if you look at the overall debt, the one in blue dotted line, currently it stands at about 4.2%, which is just a little bit higher than where it was before pandemic. So I wouldn't say that delinquencies are a risk in our industry because they haven't moved up that much. And then when you look at student loans, yeah, it has moved up, but remember a lot of student loan forgiveness programs ended sometime at the end of 2024. That's why you see that spike. But again, if you compare it to where it was before pandemic, it hasn't moved much. Auto loans a little bit up, nothing to worry about. But the one that I worry about is the credit card debt. And it's at about 13.1, 13.2%. That is the highest in a long, long time. And that's a sign of what we call a K-shaped economy. So think of letter K. On top of letter K, you have all those clients, consumers, customers that are doing pretty well. They are not feeling the pain of inflation. And then at the bottom K, you have all those clients, consumers that are feeling the pain from inflation. So this is strictly or sort of an isolated problem is those who cannot afford everyday expenses that are using credit cards to pay for them, and they fall behind their payments. So overall, the delinquency rates are sort of not a red flag for our industry, at least currently, and hopefully stays that way. But I would definitely keep an eye on credit card and maybe a little bit on student loans, but mostly on credit cards. All right, so that was on the macro picture, right? What we saw in the economy, and those were some of the things that affected our industry. Now let's jump into our some of the stats, recent stats for the average markets, and see how the industry performed. I would like to start with demand because it's extremely important in our industry. So if you look how demand behaved on quarterly basis over the past 4 quarters, I'd say it's doing pretty well. I mean, look at third quarter 2025, barely saw any absorption. The fourth quarter 2025 was negative, over almost, I think, 40,000 units. First quarter a little better. Now, the second quarter 2026 is doing pretty well. So a little less than 200,000 units absorbed. I believe it was 190. Don't quote me on that. So is it as good as the second quarter 2025? Absolutely not. But it's still, considering how, where the economy, the weaker jobs, higher inflation, lower consumer sentiment, I think demand did pretty well considering all of these things. Now, another chart to show that demand is doing pretty well is if we compare it to 2025's supply, right? So last year, absorption was about 1.7 times larger than supply. This year, absorption is about 1.8 times larger than supply. So if you look at the raw numbers, yeah, 2025 was better. But if we look at this ratio, 2026 is better. And I would much rather take the ratio over the raw numbers because they show the real picture, the real situation, what's going on. And no doubt supply is coming down. We'll show our forecast chart later. Supply is coming down, and that is helping with pretty much everything in our industry, at least in the short run. What about rents? Well, that's another story. I think July rents month over month came in at about 30 basis points versus about 42, 43 for 2026. But I would say over the past 4 months, 2026, in terms of rent growth, has been much better than 2025. I mean, if you go all the way back to January, if you look at 2025, those blue lighted bars, uh, January through March was much better in 2025 than in 2026. But then comes spring, 2026 has been much better than 2025, at least so far. But we will have to see what's going to happen in the second half of this year, because as you can see on the chart, usually in the second half of the year, rent growth kind of dips, goes into negative. That has been the case, even if you look at pre-pandemic averages, 2015 to 2019, but even more so in 2025 when rents dipped by almost 1 full percentage point back in October. So bottom line, this year rent growth is doing a little better than last year, but we'll have to wait on the second half of the year to see to get the full picture. Now, if we look at the effective rent change as of second quarter for many markets, we see that a lot of them are doing much better now than they used to. So what you see here on the vertical axis here, you have the effective rent change as of the second quarter of 2026. And at horizontal, you have how much those markets showing how much they have moved off of their lows back in 2023. For example, if you look here at Jacksonville, uh, rents didn't grow much. Actually, they shrank by about 0.5 percentage point, but they were about 460, 470 basis points up from their lows in 2023. So the majority of markets have seen improvement since their lows back in late 2020, 2023. But only a few of them still sit at that point, such as you have Cincinnati, you have Cleveland, you have Fort Worth. You have some pretty big areas that are still struggling for various reasons, but also one of them is also supply, right? A lot of units have come online and the markets are just having hard time absorbing all of it. Now, a little bit on concessions because I don't think they have been this high, right? Probably all of you on this call get asked about this a lot. So what you see here is concessions going all the way back to second quarter 2006. The purple line shows the percentage of those units that are offering a discount, and they're represented on the left-hand axis. So at the end of the second quarter, stood at about 20, I want to say 22% on average. So about 22% of all units are offering some kind of discount. So it's not the highest point, but it's pretty high. The one that takes my attention is the average of days free, represented by these blue bars. And right now it's sitting at about 27, 28 days. That's a 16-year high. Just think about it. So right now, on average, we're offering about 26 days free. And I wish this was the case when I was a student, but that's a different story. But the difference is pretty big if you go through each asset class. So, for example, of Class A, about 21% of units are offering about 20 days free, and then Class B a little bit more. But look at the difference between Class A and Class C, right? About 50% higher Class C than Class A. So over almost 31% of units, Class C units, are offering about 20 days free. So that's almost a month free. And of course, no need for me to tell you that this is playing a significant role in effective rents. This is what's bringing those annual effective rent growth down. All right. just a quick summary here for those positive trends that we saw just briefly. I know you know how to read, so I'm not going to go through all of them, but we said that demand was pretty resilient, right? Considering everything, about 190,000 units were absorbed second quarter. So that's pretty good, I would say. Class A, it's probably one of the strongest among all classes, and we'll share some more information about asset classes shortly. And then on the negative side, negative trends of again labor market, it continues to disappoint, right? We'll see if it strengthens, but the problem is if it strengthens, then there's a chance that Fed will increase rates. If it's not that good, then it's going to affect our industry. So we'll have to see. And also, another negative is that concessions are at the 16-year high, as we saw. All right. So now let's dig a little deeper and talk about asset classes because, in my opinion, if you look just at market averages, you know, sometimes they, give you the impression that everything is moving, at the same time in the right direction. And right now, in fact, there's not just a single market in our industry. There are three different markets here. We have Class A market, Class B, and Class C that are moving completely in different directions, right? So that's why I believe that digging a little deeper, looking by asset class, we get a better picture as where our industry is standing right now. So, but first, let's start with the traffic, right? Let's look at the leads per unit. So, if you look at the orange line here, you see the year-over-year change in leads, and they're represented by the left hand side axis. So right now they're pretty flat. It had a pretty good year in 2025. They moved about between 5 and 7%. But right now in 2026, they're pretty flat, right around 0%. And then if you look at leads per unit, right, not the change, but leads per unit, represented by the blue bars. Right now, they're standing right at that second quarter average, going all the way back to 2018, right? So we have about 1.4 leads per unit. Is it great? Well, maybe. It's much better than where we were in the fourth quarter of this year, fourth quarter of last year, so on and so forth. So uh, only, I would say, 2022 and 2021, second quarter of these 2 years beat what we saw in the second quarter of 2026. So I don't think we can complain much about it here. And what about retention? Retention rates have been on a roll for at least past 2 years. So if you look at that purple line, represented in the left axis, it stands at about, I would say, 56%, which is pretty good. I mean, it has been moving up since the fourth quarter of 2023 for various reasons. So, and if you look at the annual change in BIPs, been doing pretty well, about 100 to 120 basis points move in every single quarter, at least since second quarter of last year. So I'd say, we're getting high retention and also leads per units are doing well. So can't complain much about these two when it comes to our industry. Now let's talk a bit about each asset class. Let's start with Class A because it is outperforming every other class, right? And for various reasons. First, if you look at that delta between Class A and Class B and C, that gap is kind of getting wider and wider, at least for over, gosh, 4 years. So right now, that gap sits at about 300 basis point right here. I believe that in June, rents here grew about 3%, 2.8%, 2.9%. Don't quote me on that. So Class A has been doing pretty well, but it all goes back to that K-shaped economy. These are our clients that sit at the top of letter K. They don't care much about inflation. Their wages have been growing up, right? And so just pretty much they don't feel inflation. Then on the other hand, we have had a few, or rather fewer move outs to single family homes because we thought that once pandemic is over, we're going to see a lot of people leaving our industry and moving to single family homes and just buying homes like crazy, which has not happened at all. And then you have also growing renter by choice cohort, which means even though they can buy a home, they choose not to buy because they don't see much value in buying a home, and it's sort of a shift or change in U.S. Mentality. And this my opinion. The American dream is not anymore. Let's buy a home because it will grow wealth. The American dream now is I want to rent wherever I can. I want to buy some bitcoins. I want to invest money there. That's how you create wealth. So that's what we mean by renter by choice. They choose not to buy, but they choose to rent. And then you have also the fourth factor here is the renter filtering, right? You have as these properties Class A offer a lot of discounts, right? Folks from Class B apartments choose to probably move out of B and move into A, right? And then from C to B and so on and so forth. So renter filtering is also contributing to Class A to outperform all other classes. Class B been doing pretty well, right? It's rents in the second quarter grew at about 1.5%, which is pretty well. Uh, this these or rather this sub industry right here or subcategories heavily impacted by employment and what kind of jobs get created, right? Um, but overall, this industry has been normalizing, not growing as much as Class A apartments, but not doing as bad as C apartments as we'll see in just a little bit. And probably most of you already know this, but it's Class B represents over 50% of all units, right? So it's a big factor. If Class B goes up or down, so does the market on average or industry average. And because Class B is so big, we can sort of put it under two buckets. We have Class B plus apartments that behave like Class A, and then we have Class B minus, which behaves like Class C. Last but not least, we have Class C apartments, which have been struggling the most. Here, rents still dip by about 2% for many reasons. These are your renters that are really feeling the pain of inflation, right? Their inflation is eating their lunch money, right? And plus also immigration reforms hit hard this apartment segment. So, and we talked a little bit earlier about renter filtering, meaning those that are in Class B, they move to Class A. Those from Class C move to Class B. But there are no Class D. So Class C is sort of left out alone, trying to find ways how to lure clients back to Class C apartments, and that's one of the reasons also that has been struggling. And one thing that surprised me here is the marketing costs rather have doubled for this class over the past 3 years. Just think about it, has doubled. And this phenomena is only for this asset class, but not the other two. Not that the marketing costs have not gone up for the other asset classes, but not as much as here. One last chart when it comes here to rent growth by asset class is looking at the cumulative rent change for all asset classes from 2023 all the way to 2026. As you can see, Class A here, the first half of the year always does much better than the second half. So especially in 2026, as you can see, first half was spectacular in terms of rent growth, but we'll see what happens in the second half. Same for Class B, rents grew, not as much as here for Class A, but still they grew. But look at Class C, right? Second half always does worse than first half. So here, rents shrank by about half a percentage point. So we'll see what happens in the second half. If history proves right, we will see a much deeper rent cut uh, for this class, but we'll see. Last but not least, uh, let's take a look at renewal rent growth. Uh, it's accelerating for Class A. If you look at all three lines here from going all the way back to the second quarter 2022, they kind of moved in tandem, right? If one of them moved up, the other one moved up. The other one, if one of them moved down, the other two followed. And the difference between each other wasn't that big. But look at the difference now, right? At the end of the second quarter, renewal rent growth for Class A was still about 4.2%. But look at for Class A and rather Class B and Class C. It's about 3.3, 3.4%. So it's a pretty wide gap right there. And before the pandemic, actually was Class C that was gaining momentum rather than Class A. But we're living at different times, and therefore we see that Class A here is that asset class that is accelerating versus Class B and Class C. All righty. Let's take a look at some of the regions that we track. And in the interest of time, I'll just go through them briefly. I know we have only about 5 to 10 minutes, but if you have any questions, feel free to ask at the end, or you can send them to Chris, and then he can pass them on to me. So we'll start with California here, and California is right, not growing but also not shrinking. It's right there where the national average is, around 0%. But if you look at the markets, there's a huge gap in terms of rent growth between each market. I mean, look at San Francisco. Year over year, rents grew almost 11%, San Jose 6%, and then you have Oakland about 3.4%. And why is this happening? Well, because of AI. There are a lot of companies that work on AI. They are located around these areas, right? So therefore, a lot of folks, a lot of capital is being moved to these areas. Therefore, people are following, and rent growth is following as well. But you also have other markets here that year over year are negative, like Los Angeles. Then you have San Diego. But if you look at quarter over quarter change, all of them are positive, right? Especially San Francisco seeing 510, or rather 5.1% growth quarter over quarter. Florida, well, supply has always been an issue, or at least since the pandemic for this market still behaving, or rather rent growth is way below the national average. But good news is that 6 out of 7 large markets that we track here saw quarter over quarter positive rent change. But if you look at annual figures, Sarasota is probably the worst here, negative 8.2% rent growth. Tampa about negative 4.6. But if you look at West Palm Beach, it's pretty good, about 1.7%. Again, this has to do more with supply rather than demand. Demand-wise, the market is doing pretty well, but it is, supply that it's causing problems on the rent side. Midwest markets, depends where you look. Supply here has never been an issue. Therefore, they're performing above the national average. Rents here grew by about 1% first quarter of 2026. In terms of annual rent growth, all of them are at least at 0%, and the majority of them are seeing positive rent growth, with the exception of Louisville, still about half a percentage point rent cut here year over year. But on quarterly basis, all of them are seeing positive rent growth. the highest here, Grand Rapids, 2.6, but also in terms of annual rent change, they're at 2.4. Northeast, again, supply here has never been an issue. Rents are growing, maybe a little bit less than what they used to last year this time, but hey, pretty much all of them are seeing positive rent growth, with the exception of Boston, which pretty much is flat. But other than that, this market is doing, or rather, this region is doing pretty well. Then we have the inner west. We have some pretty big markets here. And if you look, like you have Honolulu at 7.1%, but then you have Denver at negative 5.4%, right? There's a pretty big difference here. But in terms of improvement from second quarter 2025 to second quarter 2026, Tucson has seen the largest improvement, or at about 200 basis point improvement. Good thing here is that all markets are seeing quarter over quarter positive rent growth, but on annual basis, besides Honolulu, every single market here is still in the red. South Atlantic, oh boy, this is proof that supply is local. I mean, look at Charlotte, look at Raleigh, and then look at Virginia Beach. About 800 basis point different. Charlotte, year over year, negative 3.1 rent growth. Virginia Beach, 5% almost, right? And but all of them are seeing positive quarter over quarter rent change. And again, supply here is the main culprit. A lot of units were delivered in Charlotte and Raleigh, not as many in Virginia Beach. And demand has been pretty good here. Therefore, you see this huge jump in rent growth versus here in Charlotte in terms of annual growth. A few Texas markets here. Well, all of them are seeing pretty good improvement on quarterly basis, right? Besides San Antonio. If you look at Austin, has improved about 236 basis points since second quarter 2026. Yet, annual rent growth is about 5.1% negative, right? Because a lot of units were delivered in Austin. Then a lot of people stopped moving in Austin. Again, I would blame supply rather than demand on this part of the country. Southeast, pretty much the same stories in Florida here. A lot of units were delivered. You have Nashville absorb a lot of units. Same in Memphis, Atlanta, so on and so forth. Majority of them are still seeing negative annual rent growth, but on quarterly basis, all of them are seeing big improvements here. All right. So we talked about macro themes. What were some of the factors that are impacted our industry? Then we talked about what is going on in our industry, both at market level and asset class level. Then now the last but not least, I'd like to talk a little bit about our forecast, right? What do we think will happen in the market in 2026 and in 2027? So are you ready? So is our forecast. So a lot goes on when we do our forecast. So it's not like we're just taking the historical data and just producing those numbers. So we look at the various external factors that could affect our industry. So naturally, some of them are working with the forecast and some of them are working against the forecast. One that is working with our forecast 2027 is, of course, supply. I mean, look where it was in the first quarter 2025 or fourth quarter 2024, right? About 600,000 units. And now we're down to 340,000 units for 2026. And 2027, based on our pipeline and forecast, we'll see about 320,000 units delivered, right? So if you compare from peak to trough, that is a 45% difference, right? In 2027, supply will be about 45 to 50% below where it was in the fourth quarter of 2024, right? So that is working with our forecast. So that's one of the reasons that you see rent growth jumping or stabilizing in the fourth quarter, right? Will be positive, not too much, around half a percentage point for 2026. But as we move into 2027, we think rents will grow by about 2.8%, 2.9%. So a little bit less than 3%, which I don't think anybody on this call will complain about it. Some other things that are working with or work with our forecast is stabilizing inflation, right? Things are getting a little better, hopefully, especially the most recent reports show that inflation is slowing down, right? It's not where we want it to be, but it's better than it was. And another thing that is working with and against is employment. So employment is still the economy is still generating jobs, despite the fact that in July it shed about 23,000 jobs. Still, overall, we still have positive employment growth. So that is sort of helping. And we talked about improvement in rent to income ratios. Right now, it stands at about 22%, so right where it was before the pandemic. So rents have become, or rather, renting has become more affordable now than it used to, and that is a positive for our industry. Now, some things that work against our industry, jobs, right? Yeah, I said, yeah, it's helping because it's generating demand, but it's nowhere near where it used to be 2, 3 years ago, right? So it's still weak, and hopefully it will get better. Then we have consumer sentiment. Showed the chart earlier. The consumers are not feeling so good about our economy, and that leads to fewer households being formed. And then we also talked about that K-shaped economy. Those who rent apartments, C apartments, are really feeling the pain of this economy because inflation pretty much is eating their lunch money. Now, if we look at some of the markets, right? So what you see here is a 2027 annual rent change, and on the horizontal line here is how much is it going to change from where we sit right now. For example, if we look at Fort Worth, right, it will at the end of the 2027, rents will grow about 1%, which will be about 320 basis point improvement from where they are sitting right now. So majority of markets are going to see improvement. I mean, if you look Miami, rents are going to go by 3.2, 3.3% in 2027. And that's an improvement of about 350 basis points from where they are right now. I mean, in terms of improvements, I mean, you have Nashville here, you have Raleigh, Durham, almost 450 basis point improvement. So the majority of markets are going to be better off in 2027 than they are now. But of course, there are some exceptions. For example, San Jose rents will go by 2.5%, but they will be about 350 basis points below where they are today, right? But bottom line, majority of the markets will grow. Another look at our forecast from a different angle. I'm not going to delve deep into this. If how did the first quarter of, or rather the first half of 2026 compare to the first half of 2025? Those that have green diamonds means they did much better. For example, if you look here at San Francisco in 2026, so the first quarter, second quarter, so the first half rents grew about 8%, which was about 3 percentage points better than in 2025. So the majority of them did better. A few of them did the same, but of course, some of them did worse. For example, if you look at Cincinnati, 2026 first half rents grew about 1.5%, which was almost 2 percentage points below where they were last year, right? But the majority of them did well. Now, here's, I don't know, sort of a funny chart here. So how much will effective rents need to grow in the second quarter, or rather second half of 2026, to beat the second half are 2025? And the answer is, well, most of them can have negative rent growth and still beat 2025, which means 2025 was really, really bad. For example, if you look at Denver here, even if rents in the second quarter, or rather second half, shrink by, let's say, 5.5%, 5.6%, at the end, it would still be better than what we saw last year. Only a few markets here should be in the positive, like, for example, San Francisco. In order for the second half of 2026 to be the second half of 2025, rents would have to grow about 2%, right? Um, Last but not least, here's some of the things that I'm watching. Some of them excite me, and though excite is probably not the right word because I don't think there is anything in the world that can excite economists. But still, here are the two things that I think will contribute to our industry. You have incomes are outrunning rents. We showed some charts earlier that rents are coming down. Meanwhile, incomes are growing. And even latest jobs reports show that incomes are growing. We also saw that the rent to income ratio is coming down. So that is helping. Also, we are having a growing renter generation. We talked about how, for many, that makes more sense to rent rather than buy. Some of them, do it by choice, right? They just don't want to own a house. But according to a recent report, the payment on an average median priced home was about $3,200, $3,300 a month. Now it takes about $120,000 to cover for that. Back in 2020, that was only $66,000. It's a huge jump, right? So that's one of the reasons now people choose to rent versus buy. Then, according to a National Realtor Association, the median first-time home buyer age was 40 this year versus 38 just a year ago. So again, people now are choosing to rent for longer versus buy. So these are some of the things that are going to help our economy. And of course, there are the things that are going to keep me up at night, should keep us up at night if we are part of this industry. Inflation, right? Yeah, it's coming down, but you never know what's going to happen, right? If oil prices keep going up, eventually they will affect every single part of our industry because, America doesn't run on Dunkin'. America runs on oil. And if oil prices go up, we are going to feel the pinch, all of us. So hopefully it will start coming down, but as it stands, I would keep an eye on it. And then under building the next cycle, right? If you look at the permits, they're down about, don't quote me on that, about 5-6% year over year. So yeah, we are solving a problem by not building a lot because that's how we'll get the rents to move up. But what about 2029? What about 2030, right? We know that in this industry, the lead time is about, 3 years. So what doesn't get started in this year will not deliver in 2029, right? So by solving a problem now, are we creating another problem that we'll have to face in 3-4 years? All righty. So that was my spiel. Hopefully, share something that you guys enjoyed. But if you have any question and I can answer it, please let me know.
Yeah, absolutely. And Arben, I do want to thank you for providing all this useful information. And if anyone does have questions, feel free to type it into the Q&A section, and we'll get Arben to answer them.
Let me stop sharing because I won't be able to see if anybody's typing.
Okay, while we wait for questions, Arben, would you be able to provide the deck to us that we could send out to the broader audience?
I should be able to provide it, not right now, but I can send it to you throughout the week, probably tomorrow, and then you can share with the audience without any problem.
Okay, awesome. Thank you very much.
Absolutely.
And And do we have any questions from the crowd?
I usually have questions after everything is over. So if majority of attendees are like that, probably you'll receive some questions in your mail soon
Okay,
by email.
absolutely. Well, yeah, once again, I do want to thank you for joining us. It looks like
Absolutely.
we do have a question. The question is asking about your thoughts on Clayton, Missouri.
Clayton, Missouri. Here's the thing. I don't have the data in front of me, but it is a market that we track, and I could dig a little deeper and we'll get back to you if you provide your email address.
Okay, and I will send you that email address offline as I do have it.
Absolutely.
But no,
We,
well,
we track over 400 markets, so it'll be sort of hard to, know by heart every single market and what's going on there.
absolutely, absolutely. Well, thank you very much again, Arben. And if anyone does have questions, feel free to reach out, team at disruptequity.com, and we will be sure to get that over to Arben. And I want to thank everyone for joining us today. Have a
Thanks
great one.
again for the opportunity. Take care.